Okay, good afternoon, everybody. Let's go ahead and get started. Let me know if you guys can hear my audio and see my screen in the chat box. Just give me a little Y or a yes there. Just want to welcome everybody here. Also, just want to give a shout out to everybody in the recording. Want to say hello to you guys. Just want to just want to welcome you guys here. Well, awesome. Well, let's go ahead and get started. Before we get into the disclaimer, I just kind of want to introduce the topic. So today I've had a few requests come in from some people asking me to talk more about the liquidity in the market and what is liquidity. You often see me in the live trading webinars trading what we call liquidity zones. They're also known as order blocks, supply demand. So what I wanted to do today was just kind of introduce from the very basics of like what liquidity is, all the way to how to identify it, and then also to application into the market. So I want to help you guys be able to identify it and then use it for the purposes of making money. Okay, so let's go ahead and get into this. Before we jump into my presentation, I want to share a disclaimer. As always, I need to remind you about the risks involved in this market. You can lose all or more than your initial investment if you're not careful. So please be aware of how many pips you're risking on each trade, in addition to how big your lot size is and ultimately how that would affect your account if you were to lose money. So make sure that you're going through that process each and every time that you take a trade. All right, guys. So let's actually let's do this first. I have a few slides I want to share. Then after I share these slides, I want to spend some time just on the charts. So we'll maybe spend like 10, 15 minutes on these slides, and then the last maybe 15, 20 minutes on the charts. So first of all, let's explain what liquidity is. I've got a cool definition here. Liquidity in Forex is the ability of a currency pair uh, to be bought and sold in the Forex market without majorly impacting its exchange rate. When a currency is easily bought and sold without a lot of fluctuation in its exchange rate, it is considered a liquid currency. So that's a very, very basic definition of what liquidity is. You'll often find liquidity zones in the market are during contraction phases. In fact, real quick side note, 80 to 90% of the time, the market is in what we call a contraction phase. So 10 to 20% of the time, the market's actually expanding. What that means is most of the time, the market's doing nothing. And then 10 to 20% of the time, the market's actually moving, okay? And moving lots of price, okay? Um, Expansion does not happen unless it's preceded by a contraction phase. So contraction is where buyers and sellers are going back and forth saying, hey, I own this many euros for this price. Do you want to buy it from me for this price? And then they make an agreement together, and that's what creates contraction, because there's people buying and selling at a very specific location, and they just kind of buy and sell for a long time until somebody comes along and sends the market up or sends the market down, and that's called expansion. And so liquidity is often where most buyers and most sellers spend most of their time, which is key to understand why liquidity is important and why it works. Okay. So how can you identify, or how can liquidity help you trade and become a better trader? So it can do a couple of things. It can help you find locations where the market is about to change directions, which is honestly the key point. Trade where the big boys are placing their trades. Learn to take profit around liquidity, so it's helpful in managing risk. You'll also learn how to enter positions around liquidity zones. It'll also help you avoid being stop hunted. So stop hunted is, I don't think it's an official financial term, but you'll often see the concept of being stop hunted advertised on Twitter a lot. You'll hear me talk about it, and it is a concept. But basically, the whole idea of being stop hunted is, you place a trade, you place a stop loss on that trade, and the market just inevitably goes to your stop loss and then ultimately goes in your favor after you got stopped out. That happens a lot. Sometimes it's appropriate to hit your stop loss and just be out of the trade, but there are a lot of trades we could avoid losing out on, that could have turned into really good trades. So we don't want to lose trades that could be really good later. And so if you know how to find liquidity in the first place, you're going to avoid stopping out too early, and you're also going to take a lot better trades. So this practice is perhaps the best thing to understand, in my opinion, in order to avoid that phenomenon that a lot of retail traders talk about. It'll also help you improve your average risk to reward ratio to levels you never thought possible. So, for example, for me, uh, when I first started trading, I thought it was pretty good if I could get a 1-to-1 risk to reward ratio, or if I could get a 2-to-1. I thought that was the eclipse. I thought that was just amazing if you could get a 1-to-2. After I've studied liquidity and I've learned how to find it, I'm now taking 3-to-1s, 4-to-1s, and 5-to-1s. And in some cases, you can even do better than that. I've actually taken trades that have been 1-to-15. And these types of trades are the types of trades that if you can take 2 or 3 of them in a row, you'll pass a prop firm challenge, right? But they do take some skill and practice and time to be able to identify what a really good trade looks like. But when you can trade like this is perhaps the most superior way to trade in the market, in my opinion. Perhaps even better than the COT report. I think the COT report is great. Obviously, I continue to trade it. I've put millions of dollars in funding into the COT report. Many of you have allocated a lot of capital to the COT report and will continue to do so. But when you can trade like this, when you're just a hunter, when you're this type of trader, the type of trader you are is you basically throw on your backpack, you've got a nice sniper rifle in the back with you, and you're just going up to the mountains to hunt. That's all you're doing with this type of trading. So for some people, this really matches their personality and the type of trader that they are. But it comes with its drawbacks. So what are some of the drawbacks of this type of trading when you're looking for liquidity? Well, sometimes you'll be wrong. Sometimes you'll shoot your sniper shot and you miss and you scare off the prey and you lose, right? And it can happen multiple times in a row, right? Sometimes you're too accurate. Sometimes you're so accurate that that's actually a problem too. You can be so accurate that you end up hitting your stop loss prematurely because you're so darn accurate. So there's a nice balance to find, right? With this, and it can come with its own drawbacks, and it can be an emotional ride. When you're winning, it's great. When you're losing, it's not fun either. But the other benefit, though, is that when you're trading this type of style, typically your losses are pretty small. So anyway, let's continue that discussion, but just some things I want you guys to be aware of. So let's talk about bank liquidity. So like I was saying earlier, 80% of the time, the market's in what we call contraction zones. And this is a contraction right here. So you can see these series of candlesticks just on my chart. Lots of candlesticks just sideways back and forth. Then you'll notice, just before this, you had kind of an expansionary time. And then right after this, you had another expansion. And again, the market spends 10 to 20% of the time during expansions. It's similar to last week. If you guys remember with the COT report, we had, all 6 trades we took. One particular trade was the dollar yen. That trade by Thursday was up 100 pips. If you had just waited one more day to Friday, you would have made over 300 pips on that one trade. So the dollar yen moved up over 200 pips in just one single day. So that's why I'm saying a lot of the times the profits made in the market, they come quickly. The losses also come quickly. And most of the time your trades they'll be doing nothing. Okay. I can't tell you how many times. So I have several accounts that I trade where I only trade liquidity and nothing else. And same thing, I have lots of accounts where it's just COT report and COT report only. In both cases, in both accounts, I'll wake up and sometimes I'm pleasantly surprised to see how quickly everything worked out. I've also woken up surprised, like, oh wow, that definitely didn't work out last night, right? It's both ways, right? I definitely see it both ways. But it's just because of this very concept, right? So anyway, liquidity, like I said, usually is found in a contractionary phase followed by an expansion, whether that's up or down. And if it's really strong liquidity, that created that subsequent expansion, it will also break structure. So you'll also see here this line, the market broke that structure level. What this means is the market was so robust when it made this move that it broke through psychological and physical barriers that existed in the market, and the market was able to go through that. So what that does is it creates what we call an imbalance in the market. And that imbalance exists because you have happy buyers who are down here who bought in originally into this contraction that ultimately came an expansion to the upside. So they're sitting happy. Then you have the sellers who unfortunately sold in this contraction here, this sideways movement. They're stuck and they are losing on their position. So it's an imbalance because when this and if this market pulls back, what's the chance of a seller getting out of their position if they've been suffocating on a drawdown for a while and they finally get a chance to close at break even? Well, the chance is actually highly likely that they will close out their position because they don't want to stay in that trade anymore. Okay, because they've been losing, and now they finally get an opportunity to get out. So they're going to mitigate their position and fill that, what we call that, fill that imbalance. And then that will send the market even higher. You'll see that on the following slide. So here's an example of what I was just talking about. So you have this contractionary period over here where we have trapped orders, also known as liquidity. Then you have the expansion that happens very quickly and it breaks structure. Then you have a market that pulls back. When it pulls back, it's tapping right back into the same area. These lows right here are the same area where this mitigation, or excuse me, not mitigation, where this liquidity once was, this sideways movement or contractionary phase. So what's the psychology of each trader? So the buyer is thinking, hey, this might be another opportunity to load up on more positions. But most importantly, it's the seller who got trapped in a bad trade who finally has an opportunity to exit. Okay, that's who you're talking about right here. And that seller is going to exit their position and at break even. And what that does is when a seller closes a position, what does that do to buys? Well, if a seller is selling, that means they're now a buyer, because in order to close a sell, you have to buy. So if a seller is selling their position here, that really just means a seller is buying. So a seller is buying right here. And then you also have other buyers. So there's a massive load of demand right here. So when we say supply demand, this is what we're talking about. So there's a demand right here because sellers are exiting and buyers are buying more. And that's what causes the market to expand yet again. And it feels what we call the mitigation. It's you're mitigating the imbalance and the trapped traders who existed right here. You're filling that in, and that's what causes the market to break out from there. So this is the essence of liquidity trading. This is the most basic example of when we say supply demand, smart money. This is the concept. Okay, here's another example in a live market. This looks like the Euro franc. I took this picture several months ago when I first made this presentation. So I don't remember when this was. It was on a 15-minute chart on the Euro franc several months ago, if you're curious. But right here, you've got a market that was going up and up and up, expansion, and then it goes into a contraction phase right here, kind of contracts sideways through here. And you've got a nice support level right here. And this market starts to break through that support level right here. So we call this the BOS, or break of structure. So what that means is there's liquidity trapped in the last area wherever there was a contraction that created the expansion necessary to break the structure. That means there's liquidity in there. Okay, so again, let me repeat that. So you have contraction here, a nice move to the downside. Then you have a break in the structure, a kind of a weird break. It's not very clear, but it's not like a big, massive single candle, but it definitely violated this support level. And so what that means is there's trapped buyers up in this area. And if the buyers are given a chance to get out of their buys at break even, they will. And if a buyer closes their position, what does that mean? What does that mean that they're doing? If a buyer closes a position, that means they're selling. Okay, so you have sellers and now you have buyers closing. So you have a bunch of sell, which means there's a bunch of supply. Supply is associated with selling. Demand is associated with buying. Okay, so most, that's important to know that. So we have supply that's trapped up in here because not that there is supply, but there is an incoming amount of supply because you have buyers who are stuck. And if they're given a chance to mitigate, they will mitigate. Guaranteed they will mitigate. Okay, unless they have some secret sauce reason that we're not aware of, geopolitical reason that we're not aware of, they will mitigate. Okay, so they'll mitigate their position and then the market will head down. And you'll see that example right here. So here you go. You've got on this slide is an example of what exactly happened. So you had the break of structure, liquidity up here. The market literally came up on that single wick and mitigated that last contractionary phase, that last contraction. And then the market then fell off a cliff after that happened. Okay, so it's just as simple as that. Some people make it more complicated, and there might be better ways to trade this. I'm always open to better ways to trade this. I'm not saying I have the best way to do it. All I'm saying is I have a way that's been working pretty well for us, and we'll continue to trade it until obviously we find a better way to do it. But so, and again, like I said, what you have is contraction. You have an expansion that leaves people in the dust. You have sellers who are happy, but buyers who are unhappy. The market comes back up, fills in the imbalance, gives the buyers an opportunity to get out quickly. As soon as they're able to get out, they do. Buyers now become sellers because they close their positions. If you close a buy, you're then selling. And then from there, it falls off a cliff. Okay, so we call that post mitigation. So the trade's now over at that point. So the ideal trade, guys, is when you and I can catch the market when it's in this phase. So it needs to be in pre-mitigation, means it has not filled in the imbalance. We have a break of structure. And this is where, so when the market's in this phase right here, this is when a setup is viable. Okay, so this is an example setup. This is an example of a setup, right? This is an example of a trade that already took place, right? So I hope that helps. If you have questions, let me know in the chat box. Let me read this one question here. Brooke says, is the fact that if it is expanded and then returns to the liquidity an indicator of a bearish move? Oh, let's see. And then return to the liquidity an indicator of a bearish move or an equal chance for it to break yet again? Okay, good question. Let's see, if the fact that it expanded and then returned to the liquidity an indicator of a bearish move. Yeah, so as long as, so if we look at this example again, as long as the market comes up and tags the liquidity, it's still a bearish signal. The only time this would become a bullish signal is if the market broke above this resistance level right here and basically broke structure to the upside. Forget that liquidity, forget that supply, it's done. So we do place a stop loss right here at the end of that liquidity zone. And if we get stopped out right there, I'm cool with it. I mean, I hate to lose, but I'm okay if we take that loss because we did the best we could possibly do. We took the very best setup possible. And at that point, the trade is no longer a viable setup. So you might as well stop out when you can. Yeah, great question though. If I didn't answer it well enough, feel free to rephrase it and I'll try to re-answer your question. But let's look at some more examples here. This is a good example. You guys are in this trade with me right now. This is the Euro franc. It's starting to move up a little bit, which is good. If it continues up, we're in good shape. If we do pull back significantly from here and we retest this liquidity zone again, I will be a little concerned, maybe to the point of closing it early, but so far so good, right? So, but let's talk about why this is a good example. So let's break this one down, even just since we were in the live trading class this morning. So we had a nice trend here, and you can go off of a trend break of structure or just like a horizontal support resistance break of structure. And all those setups work great too. But I will tell you, my favorite setups, as you guys know, are the kind that break the trend. I just love those so much. I feel like they're just spot on, great trades. They really are. So what do we like about this Euro franc on the hourly chart here? So we have a nice trend. We have a point A, point B, point C, and a D. And then we have a break of structure right here. The BOS comes out. And then we identified a liquidity zone down here. Now, how did we find this liquidity zone? This one was sneaky. We were very sneaky when we found this particular trade setup. How did we find this one on the Euro franc? Well, we actually did a lot of homework. We went back in time and we went on the higher time frame here, and we went back all the way to, I think, September. We said we come over here, and this is exactly what we were just talking about on those slides just a few moments ago. So when you're looking at this area is key, because whatever took place in this contraction ultimately caused this massive move right here. Like it caused this expansion right here. Whatever expansion this was came from whoever placed orders in this area. Whatever they did here created this move. Okay. Not only did they create that move, but they also broke this structure point right here, which is also here. And they also technically broke this one or came right up to it. So they broke this structure point right here. So this is a BOS. Let me highlight it. This is a BOS. You could also call it a change in character, honestly, but we'll just call it a BOS. That's fine. Okay. So that's liquidity. And we did our homework on this trade. This is a little bit more homework than most of the time you'll have to do, but we did it just because we were looking for a really good setup. This is homework that a lot of retail traders won't do. So we went and found this. Now you fast forward to here, and now it makes sense that there's liquidity right in here. Okay. It also makes sense that there's liquidity in here because if you think about it, if you're a buyer, most buyers probably had their stop losses just below this low. So where do you think most, yeah, so if most people had their stop losses here, that means they exited their buy positions. They subsequently sold. That's going to allow the big banks and people like us to be able to buy more if retail traders close out of their buys in this general liquidity zone, then that's going to give us an opportunity to get back in. And it's going to allow the banks to grab more liquidity. So yes, I do like this trade setup. We're going to let this one continue to do its thing. And it's up, not a lot, but it is up right now. It's up like 10, 11 pips, 12 pips. So this one's pretty early, but this one we had to go find liquidity from another, we had to go back in time. We also use these order block indicators. So for those of you that don't know what indicators I use, these are free and they're on TradingView. Here's how you find them. For those of you that don't know how to find these, you go to indicators and you can search anything you want. You can search order blocks. You can search, if you wanted just a traditional indicator like an RSI, you can do that. I don't know why you would use that, but you can. If you wanted a MACD, you could use that. I don't know anybody that uses a MACD anymore, but maybe there's some people, that's fine. But I use my price action concepts and I use these indicators to find trade setups. So I'll go to, I'll just search order block detector or finder. There's several. There's this one from this guy. You got Lux Algo. This is the one that we use a lot. These are very common indicators now. I think people are kind of realizing, wow, I need to learn how to detect liquidity zones. So a lot of people are using these indicators to help them out. Okay, let's see. This is probably not the easiest setup to understand. Let's try to find another opportunity. Let's try to find another setup. So let's just go to I don't know, maybe what's your favorite currency pair? I don't know. Maybe we'll just go to the euro dollar because that's pretty common. And let's go back. I don't know, let's just go back in time and find. Okay, I see a cool opportunity here. So right here, yeah, so this market made a resistance level right here, and it looks like it might have been resistance back over here too, kind of a support resistance zone. So this is an example of what we were just talking about on those slides. So right here you have a break in structure right here because this was a apex high at the time and the market broke through that. This area right in here is your liquidity. Why is that liquidity? Because that was the last contraction phase before the market broke out. So this is your BOS here because the market obviously left this area. So let's talk about the psychology of both sides of the market when this happens. So when this happens, you have buyers who are doing great. They're happy. They're very happy that this market pulled up like it did. It's doing what they wanted. You have sellers who are trapped and they're stuck and they're not happy. They're in a drawdown. So they're suffocating on this trade by the time the market gets up into this area and up into this area. So if they ever get a chance to close their trade, what do you think they're going to do? They're going to close it. So if a seller closes a position, what does that now make them? They're now a buyer. If a seller closes a buy, they're buying, right? So where do you think a good place to buy would be? Probably in this purple area, because again, if the sellers are given a chance to get out of their bad position, they're going to take that opportunity. So now we fast forward and here's exactly what I was talking about right here. So you got this market that came right into the liquidity right here and then bounced right off of it, right? Bounced right off of this zone. Okay, so we'll go find some more examples of this, but this is what I wanted to show you is that this is before this move happened, this was pre-mitigation. So this liquidity zone hadn't been mitigated yet. Now it's mitigated. Can it work a second time? Sure. But once liquidity gets tapped into at least once, I typically don't use it again because it's already been mitigated. So you want to find zones that haven't been touched yet. Once they've been touched, they're usually not that good anymore. Let's see, does this actually work out again? Yeah, it kind of works out again right here. Does it keep working out? Yeah, it actually worked out multiple times. You can see it touched right here again, and it actually did quite well right off of that purple area. But yeah, for me, my personal rule, you guys can do what you want, but my personal rule is that if it tags liquidity once, you should be in it already. And then I'll just take the first trade because those are usually the best. In this case, it looks like it came to liquidity many times and did well. It did very well, especially on this third touch right here. But I don't typically trade it that way. So there's an example of a BOS. Let's find some more. Liquidity is everywhere. So I mean, yeah, so like here's another example right down here. It's a pretty good one, actually. So you have this downtrending market. You actually have several things here. You have kind of a trend line right here, right? Oh, this is so good, actually. This is about as good as it gets, guys. So right here on the euro dollar, this is back in May, end of May, last week of May, right here on the euro dollar. So you've got this points of engagement. So you have this trend line here, multiple points of engagement. It's definitely a trend. You have a break in structure right here on the trend line. But not only that, but this move is so robust. This is such a robust move that not only did it break the trend, but it also broke this structure right here. So you have a resistance level it busted through right here as well. Okay. And so you'll also call this a BOS. So all of this is BOS right here. Let's type that out. you have BOS here, and here, all of that is a break in structure, right? So this is now, as soon as those two things happened, it's an uptrend. At this point, it's at 100%. This is an uptrend. There's no reason to believe it's in a downtrending market anymore. As soon as both of those things happen, usually you just need a break in the trend. But since we not only broke the trend, we also broke this resistance level too in the same exact move, in the same expansion, there's definitely liquidity. So if you're a bearish trader and you see this, you're like, oh, shoot. Right? I got to get out of this thing. I'm in big trouble. So naturally, what created this move? Like what? This is an expansion. This entire area is an expansion. So who created this expansion? Well, probably whatever liquidity is in kind of this general area right here. Like whatever took place in this contraction, you could even say that whole thing. You could localize it like this maybe, but yeah, this is absolutely liquidity, because if you zoom in, you can see this was kind of the last known back and forth where the buyers were selling, the buyers were buying, and it was kind of a back and forth exchange going on in this area, in this contraction, right before such a major breakout. So if you're fortunate to capture and see this, you know that there's liquidity right in here. And not only does it pull back into the liquidity zone, but it also reattaches and engages with that trend line again right there. So you know this is a good one. And it's just off to the races at that point. Look at that thing, just off to the races, right? This, by the way, happens on every single time frame, on every single financial instrument, stocks, Forex, CFDs, metals, futures, you name it. This phenomenon exists in every market. It's cryptocurrencies too. It's everywhere. I just choose to trade it on Forex because you typically get a lot more opportunities in Forex. It's open all the time, and you can trade on different time frames and do the exact same thing I just showed you. So this is pretty dang cool. This is just on a higher time frame, hourly. So yeah, really good example here. But there's liquidity everywhere. Like you can just keep going, and I can find just some more really good examples here. This is yeah, here's a good one. So right here, nice support level right through here. Yeah, nice little support resistance zone right through here. This one's not based off of a trend. It's just based off of a break of structure. So you have nice little support there. And then you had an expansion right here, which could be an opportunity, but the expansion I'm interested in is the one that created the break of structure. So that's kind of the key, is did that expansion you're looking at, did it create a break of structure? Okay, this one did. Perfect. So I've got that. And you just highlight it. Okay, yep, that's a BOS. That's a BOS. You could even call it a change of character, that one probably, but it's at least a BOS. Now you have, in this area, you have pre-mitigation. It hasn't been mitigated yet. You have buyers who are stuck and they're very trapped. And so if this market were to come back up and retest this area, there's a good chance you'll get a pullback. This one was so weak that it didn't even quite get all the way up to, well, maybe you could say it did. It pretty much got to this contraction. But if your trade was just a little higher, let's say your entry was just up to there, you would have missed a great trade. Excuse me, you would have missed all of that. So, but if you had drawn it out like this entire consolidation right here from its high to its low, yeah, you would have made it. You would have barely made it into that sell right there. So that's post mitigation. So the market came back up, gave the buyers a chance to get out of their bad trade. And when buyers get out of their bad trade, they're now sellers, because if you close a buy, you sold, right? And then that's what caused the market to head lower. Well, and it's that, and it's also a combination of people like us who are being very astute and captured this opportunity when they saw it coming along, right? So there's another really good example. But they're everywhere. Brooks says, would you say larger timeframes are better indicators or just an indicator of how long it may take to trade play out? Yeah, so there's a little bit of both what you said. So higher timeframes, in my opinion, and from what I've noticed, typically have the best possible trade setups. Yeah, higher timeframes look pretty good. And usually I'd say the mitigations work out better there. The lower timeframes will give you more opportunities, and conversely, the higher timeframes won't. So lower time frame, yes, you'll have way more opportunities throughout the day to do this exact thing. Here's what I would do. So if you're going to trade the lower time frames and you want to just trade liquidity on a 1 minute or a 5 minute chart, here's how I would do it. You'll see a lot of professionals do it this way. So I actually know a couple of guys in Florida. They just trade full time, and in their group, this one guy's particular group, all he does is he just trades the breakout of London. So typically, so this is how I would do it. If you want to get more opportunities, this is how I would go about it. But it will require you to put some like an hour or two a day into the market. So if you have an hour or two a day, then maybe it might be worth it. But here's how I would do it. Because throughout the day, you don't have those big movements because you have to have a big enough movement to break structure, right? So if you're not trading during a time where there's enough movement to create structure, the lower time frame will give you bad signals. So if you're trading around a time that already is inherently volatile, then you will get opportunities. So the best time to look for this, Brooks, would be like the first 2 hours of London, the first 2 hours of New York, the first 2 hours of Tokyo. And specifically, if you're going to trade Tokyo, you need to trade like the Aussie pairs or the JPY pairs. So you probably want to just look at pound yen, GJ, AJ, or you'd want to look at like Aussie dollar, dollar yen. If you're going to trade, just like if you come home from work and you say, I instead of Netflix, I'll just trade mitigations for an hour or two after work, you could do that. Or let's say, you work at night and you have time during the mornings, maybe you get up for London or the New York one, and you just trade New York for an hour or two and you just trade mitigations on a 1 minute and 5 minute chart. That would work just fine. So the 1 minute and 5 minute charts will give you more opportunities and pretty good opportunities if you trade it at opens. But if you just go to any chart at any time of the day, yeah, you're going to find that you're going to have the trade quality will go down for sure if you just trade a 5 minute chart any time of the day. Yeah, so there's your answer. I hope that's satisfactory. But yeah, so yeah, guys, so I know a guy in Florida, his group, what they do is they just hop on at the start of New York at 8 a.m. Eastern, and they just wait for 15, 20 minutes. They just have, 4 or 5 charts they look at, and they wait for one thing to break out of one or two things that look pretty good that break out of a trend line or break out of a structure, and they just wait for it to tap into the liquidity, and they'll just take one trade, maybe 2 trades a day, and then they're done. It's not a bad way to do it. It's not a bad way. If you live in California, you're going to have to get up at 5 a.m. because that's when the market opens for New York. But New York, it opens at 8 a.m. So it just kind of, yeah, worst time zone. Yeah, California equals worst time. Yeah, it's tough to be a Californian. I'm sorry but I'm with you there. I'm just an hour ahead of you. I'm in mountains, so it's tough for me too. Like mine's at 6 a.m. So if I want to trade it, I have to do 6 a.m. That's actually one of the reasons why I do things like the COT report, is because I need something that's going to be consistent without me having to be at the market at obscure hours. Not bad though if you're going to trade Tokyo, because Tokyo opens at, let's see, Tokyo market opens at 8 p.m. Eastern. So if you come home from work and you live on the East Coast, and you come home from work, you maybe have some dinner, chill for a little while, get yourself a drink, and then just sit at your computer at 8 p.m. Maybe watch some YouTube while you're looking for setups, that's not a bad way to do it. Just trade Tokyo. Just 1 minute, 5 minute chart on Tokyo at 8 p.m. That's not a bad way to do it. In fact, let's end on this. Let's actually do that real quick. So I have this cool indicator. If you go to indicators and search, what's it called? It's called Sessions. That's what it is, Sessions. And it's this one by Sessions on Chart, or it's Sessions on Charts by Aurochs. If you pull this one up, this is pretty cool. Let's go to the pound yen. Or let's do dollar yen. So dollar yen's a good one to trade at the Tokyo Open. Here's what you can do. You go to the settings on this. Let's go down to a 5-minute chart. Let's just do 5 minutes. And let's go to the current day, which is here. And if you go to the settings and if you just turn on Tokyo, so turn off New York, turn off London, and just turn on Tokyo, click OK. It should highlight. It's not highlighting very, it's kind of hidden. So let's change the color on this. Style. Let's change visibility, style. I need this to look different because I can't see it very well. Maybe I just don't want to spend too much time on this. Can I change that? Yeah, anyway, let me actually try, this is the one I liked, but let me try a different one. Let's do sessions. Maybe I'll do this one, see if this does it. Okay, this looks better. And then let's go to the settings and let's change this. Yeah, so just turn off London, turn off New York, leave the Asia one on. There, so anything in purple or this blue, whatever color that is, that's going to be your Asian session. So this was yesterday on Sunday. That's not a Sundays are not a good not a good Tokyo session, but all the other ones are pretty good. So right here, you kind of have some breakouts that you could possibly work with. I can see a couple of examples on the dollar yen here. So this one actually came down to a liquidity zone. Like this was some liquidity right here, and the market came right and touched that. Another thing that I just noticed too is this market broke during Tokyo right here. It broke this structure and then had a little bit of a pullback right into here before it shot up, right? So there's another example. Let's go over here. Yeah, here's your big breakout. So yeah, this one actually did a couple of interesting things. This one broke out a structure here. It had a little bit of a return to liquidity right here, but it didn't, it kind of worked, but it also kind of just filtered out because ultimately it broke structure during Tokyo or during London. This one broke to the upside right here. So you broke this structure to the upside. Now you got to look for buys once that happened, right? Over here, here's Tokyo. This one's a good one. So right here, you have a break in structure right here at the very beginning of Tokyo, kind of a breakout. And so now you're just looking for the return back to kind of this consolidation zone. You know, whatever took place in here ultimately created this move to the upside. And sure enough, then it goes off to the races for the rest of the day. So this is just an example. If for those of you that want to trade in the evenings, you could do this. This one was kind of weird actually, because it kind of broke up and then broke down. Kind of looks like the market actually went back up to, you know, this kind of liquidity area up here. Some of them are not clean. Like this one, I wouldn't say is that good. Yeah, so this one actually did a couple of things kind of cool. So this one had a nice support zone right through here. Market kind of broke through that support right there. and then the market came back up to, you know, this liquidity zone. Because whatever took place in here is the last known thing before this market took off on this expansion that ultimately broke structure. So if you can get the market to come back and tag into this area, then there's a good chance you'll get a nice little trade out of it, which it looks like it did, right? This one was all over the place. You had breaks to the downside and to the upside. So that's one way. If you're going to trade liquidity on a smaller time frame, I would trade it around opens and look for opportunities around those opens. That's the best way that I know of if you're going to do it on a smaller time frame. Otherwise, the higher time frames doesn't really matter what time of day you're looking for trades. Like if you're on an hourly chart like I do it, doesn't really matter that much. Let's see. Brooks says, would you expect a 1 minute or 5 minute move within it to make its move within an hour, or 1 or 4 hour chart to take days to play out? Yeah, that's exactly right. So 1 and 5 minute charts, in my opinion, are for people who are scalping the opens or the closes of a market session. When you get to the 15-minute and hourly, those are people looking for intraday and or multi-day long trades. That's what I do a lot of. You'll see me take trades like that all the time. And then if you're trading 4 hour and daily, you're looking for several week-long trades. You're looking for macro trends if you're on the 4 hour or daily. So Sean says, yeah, I've been trying to figure out a good trading approach to the London Open since it's at 12 a.m. pre-market starting around 11 p.m. Yeah, you could do that. Yeah, if you're up, late and you have, if you live in Hawaii, that's probably not too bad to trade London Open because it's just your evening. If you're in California, you probably trade it pretty late. If you're up late anyways, you might as well trade it. If you're in New York, London opens at 3 a.m. That's pretty much a no can do for most people. I don't trade London open. For me, it's at 1 a.m. So I don't trade it. It's just too dang hard to trade London open. I just don't know how I would ever do it. Yeah. Okay, so those are some examples. Yeah, so right here's a good example. Right here here's the open of Tokyo. You had a break in structure right here, and then you had a return to the liquidity zone right here. So the market returned back to liquidity right there after it broke. That's a picture perfect setup right there. That's about as good as they come. This one right here, that's picture perfect. That's actually legit. Let me show you, just because we do have a few more minutes, excuse me, sorry. Let's turn off sessions and let's change sessions to just New York. So a lot of you guys, so let's talk to some of you guys on the East Coast a little bit more, right? Well, I guess if you want to do Tokyo, it's at 8 p.m., starting at 8 p.m. If you want to just sit at your computer from 8 to 10 and look for opportunities, that's not a bad way to do it. But if you want to get up at, 8 a.m. and casually just sit with your coffee or whatever and just drink and just, take some breakouts, that's not a bad way to do it. Let's pull up, say, yeah, like the euro dollar, or actually let's do USD CAD. I think that's a good one. Let's do USD CAD. And let me go back on this chart in time on a 5 minute. And let me show you how you would do this if you wanted to trade the open. So you would so you pull up the indicator, just a session, any sessions indicator would be fine, and then you just turn on New York. I'm not sure why it's, oh, there it is. I gotta unhide it. There we go. Okay, so right here is the beginning of New York. So yeah, let's just start over here. It's fine, or anywhere we want. So you have kind of a consolidating market right here. You really don't have any big breakouts right here. I guess you could say you had a little bit of a breakout right here, but really it just came back and touched that zone. and then it came back up here and kind of just touched resistance. So you didn't really have any big specific breakouts there on that one. You're looking for, some significant breakouts. That's what I would be doing. If I were to trade this, I don't see anything there. You're looking for structure to break it essentially. I don't see it there. That's kind of interesting with this one. Okay, so with this one, you're definitely breaking down. You had a support level and you definitely broke that structure there. So you're looking for mitigation back to this zone. If you could get the market to come back up to that area, that would be a great sell. It looks like it never did until there. It took 3 days later, but it finally came back up to it. Let's see if we can find another one. Okay, so yeah, this one you can work with. So you had a nice to start London, or yeah, right here, or New York. You had a nice resistance area right here that was formed during London. And then you had a break of structure that happened almost right at the New York Open, right there. That's what you want to see. And then as it's breaking structure, it pulls back into this zone, which is basically the zone that created the this breakout. And then from there, it does break out pretty hard. Like that actually breaks out pretty good. It does pull back by the end of London, but yeah, it does work out pretty well. Let's see if we can find another one. Yeah, so right here, during London, no massive breakouts at London Open, but right here you break this structure point about midway through London, or not London, I keep saying that, New York. So not at the Open of New York, but midway through New York here, you get a breakout. Now you're looking for buys. So anything that returns back to, either this area, it looks like, or even this area would have been fine. Looks like it did break out from there, but this one is good. Right at New York's open, you have a breakout of this area right at the opening of New York. So as soon as that happens, there's a missing mitigation. So you're looking for the market to come back up to the zone that created, to this consolidation that created that breakout, which happened right at New York. And as soon as that happened, that's when there's a need for mitigation. It comes back up, hits that mitigation, and then it's off to the races for the rest of New York pretty much. And then it's, that's a solid move right there. This is, so what I would do is, if you're going to trade this like right at New York, rather than just trading one pair, I would have maybe like the USD CAD, Aussie dollar, maybe the pound dollar, just currency pairs that would move really well at the start of New York, right? And then you're just looking for breakouts on those that break structure. And then as soon as that happens within the first 5, 10, 15 minutes of New York, then you can trade that. For me, if I'm up early doing this, the thing is, my routine is like this, guys. So I don't do a lot of trading at New York, even though there's huge opportunities, because I still have to live, right? I don't trade just to make a ton of money. I trade also so that I have flexibility in my lifestyle. So in the mornings, I usually like to get up and have my routines. I like to go on a walk with my wife. The summers are nice right now in the United States, so I like to do that, especially where I live. The mornings are just awesome. And I like to, shower and just get myself really ready for the day. And then I'll do a lot of trading later on the higher time frames, or I'll do something during Tokyo or something like that. That's my routine. If it works for you, because it's later in the day when New York opens to do this, then by all means do it. So let's look at some of these other questions here. So let's see. Yeah, I've been trying to figure out good on. Yeah, yeah. It sounds like we already talked about that. For your entry, do you fuss with LTF signal of some kind, or just get in anywhere once it hits your liquidity zone? Yeah. So for me, and with your other comment too, like I don't look at volume as much. I don't look at the volume because the reality is, if you're trading at the open of a market, then your volume's gonna likely there's volume that's there. And I don't know if it varies day to day by a ton. Maybe it does. The thing is, it will manifest itself through the price action. The volume itself will be manifest. So you can use a volume indicator to quantify that, but for me, it's just a matter of if this candle or these series of candles here at the start of the open is breaking all sorts of structures, then the reality is we're uh, probably there's a lot of volume behind that, and so I can work with that. Yeah, that's another thing to be worried about in the smaller time frames, Brooks, is the spread. Usually if you're trading during those opens with high volatility pairs that are prone to move a lot during those opens, those spreads will tighten up as well. But yeah, it is something to be aware of on the smaller time frames. I don't really care. I don't talk about spreads a lot because I trade on the higher time frames. But yeah, if you're going to do this style and you're looking for more opportunities throughout the day, yeah, that's something definitely be aware of. Yeah, this one right here. Here's another kind of towards the open here. You get a breakout right through here, breaks this zone. So now you're looking for buys, and it does pull back, and there's a few buys throughout the day, but ultimately it breaks below this line. And not only that, but it breaks below this the next day right here. Yeah. All right, guys. Well, these are great questions. And any other questions before we wrap up? I'm just looking at this here, just trying to see. Yeah, so here's another good example. So here's the USD CAD, here's the New York Open, kind of comes up and then it breaks structure right here. You have a nice little break of support. And now you have to mitigate this. So the market then comes back up right here, mitigates it. It doesn't quite get to this area, but it does come back up to just generally this zone through here. I guess you could even count all of that. That seems like a lot though. But it comes up into here, mitigates, and then it's off to the races again. Over here, this one's interesting. Yeah, this one is very interesting. This one, the previous day broke structure here, came back up, basically mitigated this whole zone, mitigated this, and then it was down the rest of the day. This one, there's really not a breakout up or down. I guess you could have found an opportunity either way. And that's as far as I can go. Okay. So anyway, just another way to find some opportunities on the lower time frames. That's not my favorite way to do it, but it is a way to do it. My favorite way is just to trade on the higher time frames. Usually those are going to be better signals anyway. Let's see, when you're doing price action, how do you know when to cancel your trade if you missed your entry? Seems sometimes it putters for a bit, but then makes the move. Just trust the analysis. Yeah, that's a great question. So it's easier to figure out when to cancel a trade if you're trading a trend line, because if you're trading something like a break in the trend like this, there comes a point, like if this thing takes off to the upside, there comes a point where that trend line is just no longer valid. And it is sometimes a little bit of an eyeball, but, or let's say this market comes down and breaks right through that, slices right through that trend line. Well, then it's invalid at that point too. So you'd cancel. But yeah, that makes a lot of sense too. There's some times where, I've noticed when I'm trading on the 15-minute and the hourly time frame, typically Typically, if a trade doesn't trigger within 24 to 48 hours, usually that's also an indication that it's not been good enough. Our Euro franc trade that we took on Friday, that one did exactly what we wanted. It took a day basically to trigger, and now it's, off to the races here. All right, guys. Well, I appreciate your attendance. Thank you for coming. Have a fantastic rest of your day, and we'll see you guys in the next webinar. Thanks for coming.